Folks, this is the third of a three-part video series on sectors and how to identify the top sectors, how to trade the top sectors, and how to analyze top sectors with relative strength. In the first video, I went through the top 10 sectors. I showed you the top 10 sectors that divide the S&P 500. There's about 40 to 60 stocks in each. When you combine all 10, you get the 500 S&P stocks. I showed you how to use relative strength using the 3-month high, 6-month high, 9-month high, how to average them together, and how to get the top sector, and how to analyze and isolate the sectors using relative strength, using the average of 3-month, 6-month, and 9-month highs. Now, this is the last video out of the three-part video series, and I'm going to show you something interesting. I'm going to teach you how to select options, all right, for these sectors. All of these sectors are very liquid. There's a lot of liquidity in S&P sectors, and I know a lot of you want to trade options with these sectors. So how do you select options? I'm not going to give you an option primer because that would take another probably 10 videos to make. What I'm going to do is I'm going to explain to you how volatility impacts option and how to pick the best option for these sectors. Typically, these sectors are not. Well, here's the thing. These are ETFs. These sectors are ETFs. ETFs are exchange traded funds. For example, XLE. Okay? If you type that ticker into your trading software, you would get the energy sector. So if you want to trade energy stocks, but you want to trade the sector as a whole, you would trade the energy sector via XLE. You can just trade one ticker. So instead of spending commission on 5 or 10 energy stocks, you can just buy extra amount of XLE, and then you would own that entire energy sector, and it correlates fairly well with energies. So if you look at crude oil futures and then look at the XLE, they would be correlated. Now, why is this important to options? When you're trading options on ETFs, you're going to have less volatility, all right? And that helps you because when your volatility is too high, you want to go further out of the money. All right, you want to buy options that are out of the money. But when volatility is low, all right, or when you're trading ETFs, and usually ETFs have lower volatility, you can go closer to the money. Closer to the money, all right? And let me explain to you why. ETFs are synthetic instruments. It's a trust that calculates the share value minute by minute or second by second of a number of stocks. Maybe 20, 30, 40 different stocks make up this XLE. So it's a synthetic asset. And whenever you have a synthetic asset, the market makers have to keep it in line with price. And there's less speculation on that asset. And that makes the volatility lower, and that makes it easier to buy near the money options cheaper. So when we're trading sector ETFs, don't go too far out of the money because then you're speculating too much. You're not buying any time premium, and there's a higher chance of that option expiring worthless because there's not enough sensitivity in that option to make it worthwhile when the underlying asset moves towards it, okay? So again, keep in mind, volatility is not that high. It's a synthetic asset. You don't need to go out of the money. You can go closer to the money when you're trading sector ETFs because implied volatility is not that high, so you don't have to speculate out of the money too much. And also, don't be worried if liquidity is not as high because, again, it's a synthetic asset. So the market makers will artificially keep the bid and the offer tight so that you can get filled because they're trying to keep the price in line with the underlying assets of those stocks. So there's a lot of synthetic manipulation because it's not a real traded asset. It's based on something else. So again, ETFs, you could trade the options. If liquidity is an issue, don't worry too much because it's a synthetic asset and there's always enough liquidity to get in and out. Always use limit orders when you're trading options, and always when you're trading sector ETFs, don't hold the option when it has 30 days or less till expiration. Try to hold that option when it has, try to buy that option when it has about 90 days and liquidate it at 40 to 50 days. That way, when it gets to 30 days, it'll begin, the expiration slope will go from this to this. and it's like holding ice in your hand and nobody wants it. So don't hold the option to last 30 days. If you like these videos, if you're getting something out of it, please, please, please subscribe to this channel. Talk to you soon.